Hello everyone, in this video I will be teaching financial risk management chapter and the chapter inflation. The financial risk management is quite a big chapter and it is very conceptual, so I think that will take a bit of time. So, okay, now there are six types of basic risk. Yeah, there are six types of risk: liquidity risk, interest rate risk, market or price risk, default or credit risk, operational risk, or other risk. Wait a minute. Okay, so in liquidity risks, there are three kind of risk. First is funding risk, time risk, and call risk. What is funding risk? It is basically the inability of an organization to obtain the required fund to meet the cash flow needs, like the cash they will need to for their day-to-day activities. Second is time risk. They are the risk like the need to compensate for non-receipt of expected inflow of funds, performing assets into interest. Basically, this means that whatever the cash they're expecting to meet their cash flow needs, they are not able to fulfill that amount because this happens because performing assets turn to non-performing assets. Third is call risk. This is when a bank has lost a legal battle, which results in high amount of fines they have to give. So they get into a liquidity crunch. Second type of risk is rate risk. This happens due to movement in interest rate. First kind is gap or mismatch of risk. This happens when you have asset and liabilities, but you have invested both of them with different principal amounts, different maturity dates, or different repricing dates. Thereby, you create a mismatch in the amount of risk you are taking in them. So any movement in interest rate may create a variation of interest you will receive. Second is basis risk. Basis risk is basically interest rate of different assets or liabilities may change with different magnitude. For example, for one might have a fixed interest rate of 6%, and for one another you might have an interest rate of repo rate plus minus 2%. This kind of so one might change and one might not change. Third is yield curve risk. This is basically non-parallel movement of yield curve resulting in a variation of net interest earned due to different set benchmarks. Fourth is embedded option risk. This is significant change in market interest rate may encourage prepayment of loan, is creating to risk in bank profitability. This significant okay. This happens when the interest rate of market is changing significantly, and people who wanted to invest their money are paying like okay. So people who had taken loan, they are paying their loan amount before maturity, and so the amount of interest you thought you would be receiving, you are not receiving. That is it. Fifth is reinvestment risk. Reinvestment risk is uncertainty regarding reinvestment, like at the time, at the future date when you thought you will reinvest again that amount, but at that time the interest rate is not as much you had expected. Now, third kind would be market or price risk. This this happens due to unfavorable movement in market rates. For example, okay, with currency risk or foreign exchange risk. Uh, I'm not really sure. Okay, so market or price risk. This happens due to unfavorable movement of market risk. Now, this is I think four kinds of market. One, two, three, four. Uh, even interest risk. Yeah, this is the four types. This is the first type, and these are one, two, three, four. Okay, so first is currency risk or foreign exchange risk. This is also known as forex risk. This is when suppose you have invested $100, hundred like $1,000 in an US bank, and at that time, the time like price of rupee it was generating like it was 60,000. But after certain time, when you are taking as $100, you are getting 58,000. So you are having 2,000 loss. This is known as currency risk. Second would be commodity price risk or equity price risk. This is the same, but for not for currency, but for commodity or and equity. Third is market liquidity risk. This is when market liquidity arises when banks is unable to conclude a large transaction in an instrument near the current market price. For example, the current price of a share is 30 rupees, but you want to buy 10,000 shares, but only 500 shares are available at 30 rupees, and rest 500. Okay, I think it will be 1,000 shares. And rest 500 are available at 33 rupees. So your average goes for 1,000 shares goes to 31.5. So basically you are paying a price which is not the current price, and you are paying a higher price. Fourth is even interest rate risk. This is basically a movement of interest rate which can impact the value of investments. Okay, now fourth kind. Okay, so uh, this is done. Default or credit risk. First will be counterparty risk, in which the counterparty which needs to pay you the amount back defaults somehow, so they are not able to pay anymore. Second is country risk. This is basically when the borrower is able to pay, but it is not their fault. This happens due to constraints or restrictions imposed on the borrower by the country. Fifth is operational risk, or this is basically errors or frauds. Like first can be transaction risk, which can happen due to like errors or frauds happening at the time of transaction. It can be internal or external as well. Second would be compliance or legal risk. This is basically there can be kind of regulatory sanction or legal sanction due to any fraud or error. Sixth is other kinds of risk. First will be strategic risk. This can be risk due to adverse business decisions. Second will be reputation risk, maybe due to loss of reputation. You might have some loss. Third will be systematic or undiversified risk. This is basically kind of risk happening to the entire market. And yeah, that is all. Now, what are different type of risk in banking business? Banking business, risks are divided into three types: banking book, trading book, off-balance sheet risk. The banking book includes all kind of risk related to advances, deposits, borrowing arising from commercial and retail banking operations. All assets, in banking book, all assets and liabilities are held in maturity. So this includes liquidity risk, interest rate risk, credit risk, and operational risk. In trading book, the fixed income securities held by the bank, and they're in its own account. So they have market risk, credit or default risk, and operational risk. In off-balance sheet risk, this basically includes the payment obligation on some event. So this includes liquidity risk, interest rate risk, market risk, and default or credit risk. Now, there are risk management frameworks. They created a body for financial supervision, BFS. They work on the RBI, and they supervise all the financial institutions except stock markets which are regulated by SEBI, and insurance market which are regulated by IRDA. Now they can be yeah, they have three frameworks, no, four frameworks. I think four frameworks. First is general risk management, then CAMELS, then Basel norms, then PCA framework. Yeah. Now, first is general risk management framework. This basically the general risk management structure in organization. They have I think, one, two, three, four, five, six. One, two, three. Yeah, they have five steps. You can see. First will be the organization to risk management. They have the board of directors. They have the primary responsibility of understanding the risk. The risk management company of the board, they have the responsibility to identify, monitor, and measure the risk profile of the bank. Third is the committee of the senior level executives. They are responsible for implementation of the risk and business policies simultaneously. Fourth is risk management support group. They are the group that monitors and reports the risk profile to the committee of senior level executives. Now, next is the work of this committee is risk identification. They consist of identifying different risks basically. Second is risk measurement. They measure the risk quantitatively based on its sensitivity, volatility, and downside potential. Sensitivity means the deviation of a target variable due to unit movement of single market parameter. Volatility helps us decide how the value of certain variables deviates from its average value, and downside potential basically materializes only when earnings deviate adversely. So volatility captures both upside and downside deviations. Downside potential only captures possible losses, ignoring profit potential. Okay. Now, risk pricing. Risk in banking transaction impact banks in two ways. Firstly, banks have to maintain a necessary capital as per the requirement, and second is they if the capital required is not the capital. Secondly, there is a probability of a loss associated with all risk. This also needs to be factored in the pricing. So this is how it is calculated. Next is risk monitoring and control. This includes an organization structure with proper committees to consider risk. It includes a proper organizational structure with proper committees to consider risk, comprehensive risk management approach, consistent risk management policies adopted at the corporate level, and there should be proper guidelines and other parameters used to govern the risk. Okay, so basically risk monitoring and control is they include a organizational structure with proper committee to consider the risk, a comprehensive risk measurement approach, and consistent risk management policies are adopted at the corporate level, and there should be proper guidelines and other parameters used to govern the risk. Next is risk mitigation. This measures the uh, this aims to reduce the downside variability in net cash flow, but also reduces the upside potential simultaneously. So, and also risk can be mitigated through diversification. Now, basically, in general risk management framework is basically they are present in all the organizations, and they can be done in all these six ways. That is what is written here. Next are what are camels. These are these frameworks are used to evaluate financial soundness of a bank. C is capital adequacy, M is management. No, C is capital adequacy, A is asset quality, M is management, E is earnings, L is liquidity, and S is sensitivity. So, what is capital adequacy? Exam- Examiners assess institutions' capital adequacy through capital trend analysis. Okay, let me just highlight this. Through capital trend analysis. To get a high capital adequacy rating, institutions must also comply with interest and dividend rules and practices. Other factors involved in rating assessing an institution's capital adequacy are its growth plans, economic environment, ability to control risk and loan, and investment consideration. So basically, they like assess the institution's capital adequacy through capital trend analysis. How much adequate capital is present in the institution as per its requirement. Next is asset quality. It determines the quality of loan given by a bank. So it is clear from this only. But yeah, loan given to people who are not financially sound may be defaulted by them. The factors considered here are the appropriateness of investment policies and practices, investment risk factor when compared to capital earning structure, the effect of fair market value of investment versus book value of investment. Okay. Third is management. Management assessment determines whether an institution is able to properly react to financial stress or not. This component rating is reflected by the management's capability to point out, measure, look after, and control the risk of the institution's daily activities. It covers the management's ability to ensure safe operation of institution as they comply with the necessary and applicable internal and external regulations. Okay. It covers management ensure safe operation of the yeah. Okay. Earnings. Earnings are an institution's ability to create appropriate returns to be able to expand, retain competitiveness, and add capital is a key factor in its rating. In its rating, in rating its continued viability. Okay, so institutions' ability to create appropriate returns to be able to expand, retain competitiveness, and add capital is a key factor. Okay. Next is examiners determine this by assessing companies' growth, stability, valuation allowance, allowances, net interest margin, net worth level, and quality of companies' existing assets. Next is liquidity risk. This basically assesses a company's liquidity. Examiners look at interest rate risk, sensitivity, availability of assets which can be easily converted to cash, dependence on short-term volatile financial resources. Last is sensitivity. This covers how a particular risk exposure can affect the institution. Examiners assess an institution's sensitivity to market risk by monitoring the management of credit concentration. In this way, examiners are able to see how lending to a specific industry affects an institution. Okay. These loans include agricultural lending, medical lending, credit card lending, and energy sector lending. Exposure to foreign exchange, commodities, equities, and derivatives are also included in the rating in rating the sensitivity of a company to market risk. Okay, this was all about the Camel framework and how companies are rated. That is all. Next are Basel norm. These are the norms a bank has to comply with. So these are implemented for risk management. At the end of 1974, the central government of 10 companies Yeah, okay. The central government of 10 companies formed a committee for banking supervision. They usually meet at the Bank for International Settlement in Basel, Switzerland. And Basel Accord has three norms, and BCBS committee does not have any legal power to enforce anything. They are set up by the G10 countries for risk settlement due to time difference known as Herset risk. Okay, now what is Basel 1? Basel 1 is basically they cater to the credit risk of borrowers defaulting on loans. How is CRAR ratio calculated? This is basically the capital requirement to okay, wait. So, CRAR is the capital to risk asset ratio, and CRAR ratio we have to maintain a minimum amount. And CRAR was in Basel 1, it was calculated by Tier 1 capital plus Tier 2 capital divided to the weighted asset of credit risk. Now, Tier 1 capital includes equity plus disclosed reserve minus the goodwill, and Tier 2 capital includes asset revaluation reserves, undisclosed reserves, general loan loss reserves, etc. There are five credit risk weights based on how risky it is: 0%, 10%, 20%, 50%, and 125%. And as per RBI, it should be 9%, but as per Basel 1 norms, it should be 8%. And in 1996, this formula was modified, and CRAR also included market risk. CRAR ratio equal to capital, like the Tier 1 capital plus Tier 2 capital divided by RWA of credit risk and RWA of market risk. Now, later on, Basel II was formed. It has three pillars, and it also considers operational risk along with credit and credit and capital risk. Okay, so yeah, so for according to Pillar One, the CRAR is same as Basel One. It is 9% set by RBI, and RW is calculated differently based on rating. So CRR is equal to Tier 1 plus Tier 2 capital divided by RWA for market, credit, and operational risk. Now, how to calculate all these different kind of risk? First is capital charge for credit risk method. These as three kind of, yeah, I think. Um, Okay, yeah, this is three kind of methods. First is standardized approach. This puts different exposures such as a loan to government, loan to other bank, or loan to company or a consumer in different risk categories. It makes use of external assessment to assign different risk within a category or based on their uh, rating. Second is internal rating based foundation approach. Third is internal rating based advanced approach. Now, IRB foundation and advanced approach are based on some parameters. First is probability of default (PD). This measures the likelihood that the borrower will default over a given time horizon. Loan given default (LDG). This measures the proportion of the exposure that will be lost if a default occurs. Next is exposure at default (EAD). This is for a loan commitment, measures the amount of the facility that is likely to be drawn in the event of default. Maturity M. This measures the remaining economic maturity of the exposure. Okay, this was all for capital charge for credit risk method. Next is capital charge for market risk method. This also has three methods: standardized approach, maturity method, standardized approach, duration method, and internal models of method. Next is capital charge for operational risk method. This has again three types: basic indicator approach, standardized approach, advanced measurement approach. We don't need to know about this in detail. Yeah. Now, next is pillar two of the Basel two norm. Yeah, Pillar 2 of the Basel 2 norm. This has supervisory review process. In this, supervisor personally goes to banks and evaluates all the activities, including interest rate risk, liquidity risk, settlement risk, and strategic risk. Internal Capital Adequacy Assessment Process (ICAAP). This is an umbrella activity that covers all the governance, management, and control of all risk and capital management functions. Yeah. So there are four key principles in supervisory process. First principle is banks should have a process for assessing their overall capital adequacy in relation to their risk profile. Second is supervisors should review and evaluate the bank's internal capacity risk adequacy assessment and strategies, as well as their ability to monitor and ensure their compliance with the capital ratios. Third is supervisors should expect banks to operate above a minimum regulatory capital ratios and should have the ability to require banks to hold a capital more than this minimum. Fourth is supervisors should seek to intervene at an early stage to prevent capital from falling below the minimum levels required to support. Supervisors should seek to intervene at an early stage to prevent capital from falling below the minimum levels required to support the risk characteristics of a particular bank and should require rapid remedial action if the capital is not maintained or restored. Okay, this is all about pillar two of Basel II. Next is pillar three. This covers the market discipline. This basically tells us about the degree of transparency of bank in and how public reporting should be done. This committee proposes two types of disclosures, namely core and supplementary disclosure. Core disclosure are the ones which convey the vital information for all institutions, and supplementary disclosures are required for some, but they are not secondary or optional. They are of great significance for the operation of market discipline with respect to a particular institution. So that is all. Now next is for numerical, I think, rules for calculating CRAR. Like for example, you have a tier 1 capital of 120 and tier 2 capital of 200. Now, maximum tier 2 capital which can be taken into calculation should be 100% of the tier 1 capital. That 120 plus, you cannot do 200, you have to do 120 divided by whatever is your RWA. And RWA is calculated is equal to the capital charge divided by 0.09. Yeah, that is all. Next is Basel 3 norms. This was announced in year 2010 after the global financial crisis of 2008, and This was to improve the shock absorbing capacity to and the risk management capacity as well as to strengthen the bank transparency. And all these guidelines came into effect from 1st October 2021. There were some major changes. First is better quality of capital, like maximum CRAR for Tier 1 capital ratio can be 7%, and maximum CRAR for Tier 2 capital ratio can be 2%. Now you might ask how this is helpful. Um, Tier 1 capital is considered safer. So if we are in earlier, the limit was 9%, and there was not mentioned how much Tier 2 should cover in that 9%. Now it is mentioned that Tier 2 can maximum cover 2% of that 9%. So if the maximum CRAR is calculated, it is mostly considering consisting of Tier 1 capital, which is considered more safer. Now, Tier 1 capital to the risk weighted asset is equal to common equity Tier 1 CET, which is for all over the world it is 4.5%, but for India it should be 5.5%, and additional Tier 1, which is 81, for India it is 1.5%. That is how it is divided. Next, what is CET? CET, they have discretion. These are capitals includes equity instruments that have discretionary dividends and no maturity. AT1 capital is the money borrowed by company from lenders who expect to get their money back and expect interest each year till maturity. But if the bank goes into losses, the debt is converted into equity, and lenders are issued shares of the bank, and no money is returned to them. So this is a way of restructuring the debt, and these are also called COCO bonds or contingent convertible bonds. And these bonds can also be cancelled anytime. Now, next, which was done in Basel III, was a capital conservation buffer of 2.5% above the minimum CRAR of 9% for periods or stress. So the whole buffer became 11.5%. Third was counter-cyclical buffer. This is when RBI decides whether this should be maintained or not. Like this is not compulsory and it can vary from 0 to 2.5%. Fourth is leverage ratio. This is calculated by Tier 1 capital divided by total exposure, and this should not go below 3%. And RBI recommends a 4% for systematically important banks and 3.5% for others. Fifth is liquidity ratio. This is three types. First is liquidity coverage ratio. This is basically high quality asset divided by the net liquidity flow over the next 30 days, and it should be at all times more than or equal to 100%. And for times like COVID, it can be lowered below 100%. Net stable funding ratio (NSFR), they must be above 100%, but this has not been implemented till now. And yeah, systematically important financial institutions like SIBs, they have more stringent action can be taken, like more stringent action than Basel III norms can be taken for them, but they are left for the central banks to decide. Fourth kind after Basel norms are PCA framework. These are the prompt corrective action plan, and this is learned in current affairs. Now, what is beta of an investment? This is whether an investment is more or less volatile than the market. If it is less than 1, then it indicates that it is less volatile than the market, and more than 1 indicates it is more volatile than the market. Yeah, okay. So, yeah, beta less than, uh, okay, so beta 0 to 1 indicates less volatile, but beta less than 0. I mean, a negative beta indicates that investment is moving opposite to market direction. This can be true for gold stock and bullion. Okay. Now, what is capital asset pricing model? CAPM model. This model basically calculates the return required on an investment to counter the systematic risk. And this is only for systematic risk. This is assumed that the investor has a fully diversified profile, and so that they are not having any other issue, any other kind of risk, and they have only systematic risk present. So this can be like systematic risk cannot be eliminated by portfolio diversification, and any risk which cannot be eliminated by portfolio diversification is called undiversifiable risk. and any risk which can be diversified, which can be eliminated by portfolio diversification, is known as diversifiable risk or specific risk or unsystematic risk. So that is all. Now, the this model assumes investors hold fully diversified portfolio. ER1 equal to RF plus beta I into ERM minus RF. Now here EIR1 is the return required on a financial asset. How much it is calculated? Asset I. So, next is RF is the risk-free rate of return which they will get. Beta is the beta value for a financial asset I. Next is ERM. This is the average return on the capital market. Okay. Uh, okay, so yeah, beta value for an financial asset multiplied by the average return on a capital market minus the risk-free rate of return. Now, what this total second term tells us is that which compensates the investors for an systematic risk for an financial asset. So this is the compensation for an systematic risk. And so the total ER1 RI tells us how much and uh, like return is required to counter that systematic risk. Now, what is risk premium? This is premium for this is a compensation for investors who tolerate some extra risk. Now, there are two kinds of risk: systemic risk and systematic risk. Systematic risk are the risk which is inherent to the entire market for like factors like economic, socio-political, and market-related events. And systemic risk are risk for a specific company or industry level that could industry level risk which could trigger a huge collapse. So yeah, risk that okay. So systemic risk is basically that a single company or an industry, if they could trigger a huge collapse, this is known as systemic risk. That is all. Next chapter is inflation. Okay, so this chapter is easier as compared to the earlier chapter. So, what is rate of inflation? It is calculated by the prices of current year minus the prices of base year divided by price of base year into 100. Now, there can be three kind of inflation: demand for inflation, push inflation, and monetary inflation. Demand for inflation is the when there is too much demand for a specific amount of for example, you have tomatoes. There are specific amount of tomato, but people are having so much money that they want to buy more tomatoes. So the demand is high. Next is cost push inflation. This is basically when firms increase their price to protect their profits. Third is monetary inflation. This is basically oversupply of money in the economy. Now, what is nominal interest rate risk? This is the interest rate offered by the bank. Real rate is the nominal interest rate minus inflation. Disinflation is when inflation is positive but it is still decreasing. Deflation is the level of prices are falling but the demand is too low. Next is galloping inflation. This is very high inflation occurring in double or triple digits. It is also known as hopping inflation, jumping inflation, or running or runaway inflation. Next is hyperinflation. This is inflation is large and accelerating. It is very large in millions or trillions, but for a very short interval. This happened in Venezuela in 2019, Zimbabwe in 2008, and Germany after World War One. Next is bottleneck or structural inflation. This can be a cost push inflation. This is when supply falls drastically, but demand remains the same. Next is stagflation. This is when a price for a small group of commodities rises over a period of time, but it remains stable for other commodities. Next is reflation. This is a temporary increase in price for some certain goods. Next is headline inflation. This basically reflects the rate of change of price of all goods and services. Core inflation or underlying inflation. This is the inflation. This includes the item that face volatile price movements, for example, like food and energy. Next is inflationary gap. This is the excess of government total spending over the national income intended to push the production level. Okay. Excess of total spending of government over the national income, which was in done to push the production level. Next is deflationary gap. This is a shortfall in the government total spending or fiscal surplus. This occurs due to lesser level of demand and creates a general slowdown in the economy. This is also known as output gap. Next is inflation gap or seniorage. This is a situation when a government expenditure is done at the cost of people's income. This is when the central bank reduces the purchasing power of individual buy securities from the market and they increase the cash supply in the market, which causes the prices to rise. As a result, people can buy fewer goods and services than they could before, but the amount of cash in the market is rising, and then the government can earn revenue by printing more money and lower its in real value debt's real value. Next is inflation spiral or wage price spiral. This is when wages push prices up and prices also pull wages up, and this keeps on occurring. Next is inflation accounting. Due to inflation, the process of profits of firms get overstated. Thus, when the firm calculates its actual profit after adjusting the effect of current level of inflation, then it is known as inflation accounting. Next is inflation premium. This is the bonus brought by inflation to the borrowers. Next is Phillips curve. This is a curve which tells us this is basically a curve between inflation and unemployment, and it shows us they have an inverse relationship. Third is measures to complete control inflation. There are monetary inflation, fiscal measures, and price control. First is monetary inflation. They regulate the demand side factors. They reduce inflation to reduce the money supply and induce inflation to increase the money supply. Okay, yeah. Next is fiscal measures. They regulate the supply side factor and they alter the taxation policy, they alter the expenditure policy, they reduce private spending by increasing the taxes on private business. And when private spending is more than the government more, when private spending is more, the government reduces its expenditure to control the inflation. Third is price control of goods or commodities. Now, how is inflation measured? First is wholesale price index (WPI). This has three categories: manufacturing, primary articles, and fuel and power. Now, um, okay, now currently WPI has 697 items. Earlier it was 676 items. Our base year for WPI calculation is 2011-12. Earlier it was 2004 and 5. And data for WPI is released by Office of Economic Advisor, Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. Currently, this is the seventh revision of WPI. In current revision, there are some changes which are they do not include the indirect taxes. The WPI food index to capture the rate of inflation for food index is also released, and seasonality of fruits and vegetables are updated. Index for electricity in the new series are compiled in a single item. Light diesel light diesel oil is deleted and petroleum coke has been added. In manufactured products for WPI, around 173 new items have been added and 135 old items have been dropped. In 2019, a 18-member working group chaired by Professor Ramesh Chand was created. Its demand was selecting the most appropriate base year review committee basket of okay so its demand was selecting the most appropriate base year review commodity basket of current series of WPI, review the existing system of price collection, decide on computational method to be adopted for monthly WPI. Next is CPI, Consumer Price Index. At national level, it is calculated CPI for industrial workers, CPI for agricultural laborers or rural laborers, CPI for rural, urban, and combined. So CPI-RW for industrial workers. This is released by Ministry of Labor with and Employment with base year as 2016, mainly used for calculating DA. Next is CPR for agricultural laborers. This has a base year of 1986-87 with 260 commodities in its basket. Data is collected in 600 villages monthly with 3 weeks time lag used to revise the minimum wages of this is used to revise the minimum wages of agri laborers of different states. Next is CPI urban and rural. This is compiled by National Statistical Office, Ministry of Statistics and program implementation, RBI uses CPI combined by NSO for its inflation purpose. And currently, there are 908 commodities, in which 448 are rural and 460 are urban. And base year is 2011 to 12. Third is Consumer Food Price Index (CFPI). This measures the change in retail of food products by a defined population group in a given with reference to a base year. NSO releases this in three categories: rural, urban, and combined. And separately, this has been released from May 2014 and it is calculated on monthly basis with base year 2012. Globally, Food Price Index is released by Food and Agriculture Organization of UN, which measures monthly change in five commodities: cereal, vegetable oil, dairy, meat, and sugar. WPI Food Index, this is a base year of 2011-12. From May 12th, it is released from 12th May 2017 and it measures the food price changes at producer levels. PPI, Producer Price Index, it is only the base price at producer level are used and it estimates an average change in price of producer which producer receives. HPI, Housing Price Index. This measures the price change of residential housing in India. NHB computed NHB residents with a base year of 2007 computes NHB residents with a base year of 2017-18. SPI is Service Price Index. It measures the price change of service sector. Now, inflation target is set by government in consultation by RBI once every 5 years, and it further provides a statutory basis for consultation of an monetary policy committee. As per the revised monetary policy framework, the government has fixed the inflation target of 4% with tolerance level of plus minus 2% for the second period beginning from 5th August 2016 to March 31, 2021. The inflation target for monetary policy framework has been kept unchanged, 4% level in the coming 5 years next till March 31, 2026. Now, what is the composition of MPC? One member is governor of RBI. Next is deputy governor of RBI, who are in charge of the MPC. Uh, okay, monetary policy. Next is an officer of RBI, and there are three members appointed by the central government, and each member will have one vote, and the government gets a casting vote in case there is a tie. Now there are three theories for inflation. First is market power theory of inflation. This is when a single group of sellers together decide a new price for that is different from the competitive price, and then the price is termed as a market power price. These groups keep the prices at the level at which they can earn maximum profit, and without any concern for the purchasing power of the consumers. And according to the advanced version of market power theory of inflation, oligopolists can increase the price to any level even if the demand does not rise. Second theory is conventional demand pull inflation. This tells us that the only cause of inflation is the excess of aggregate demand over the aggregate supply. Third is structural theories of inflation. This tells us that market power is one of the factors that cause inflation, but not the only factor, and inflation rises due to structural maladjustments in the country or some institutional features of business environment. Wait. Okay, next is Markup theory. Now, this theory was given by Professor Gardner Ackley, and he told that inflation occurs due to excess demand or increase in wage rates. Therefore, both monetary and fiscal policies should be used to control inflation. And one is bottleneck inflation. This was given by Professor Otto Eckstein. According to him, the direct relationship between wages and price of products is the main cause of inflation. And during inflation, prices in every industry is higher, but few industries show a very high price than the rest of the industries. And this can be known as bottleneck industries. And concentration of demand for products in the bottleneck industries results in the inflation. So these were the markup theory and bottleneck theory were included in the structural theory of inflation. So that is all.